Welcome back to the second video of the option series. Today's lesson we're going to kind of build on from the last lesson and we're going to be talking about calls compared to puts. And so the goal of this video is to explain the two types of options, which is the calls and puts, and what they give you the right to do and how each one behaves in different market conditions and kind of how they differentiate. So the two types of options. Like I said, there are only two types of option contracts possible. The first one is a call option. A call gives you the right to buy the underlying asset at a specific price. This is known as the strike price. We already talked about this. And so before the contract expires, traders and investors use calls when they expect the price of the asset to go up. And so the higher it goes above the strike price, the more valuable the call becomes. And as a reminder, the strike price is the set price you'll pay per share for company stock when you exercise your stock option. The second option is a put option. And so a put gives you the right to sell the underlying asset at a strike price before expiration. This is typically used when you believe the asset price will go down. If the price drops below the strike, the put gains value because you have the right to sell at a higher price than the current market is offering. Let's kind of look at it another way. You buy a call when you think the market is going to go up, and you buy a put when you think the market is going down. That's like the basic logic. Something many beginners miss is you don't just buy calls and puts, you can also sell them. And selling a call or put creates very different risk profile, which we'll talk about risk in like the risk profile in lesson 6. Anyways, so think of calls and puts like building blocks. Every option trade, from the simplest bet to the most complex multi-leg strategy, is made of some combination of calls and puts. And so that's why it's important to get a crystal clear on what each type actually does. Also, I do want to mention this lesson is going to be very quick. It's just calls and puts, and we're going to call it a day. So let's take a detailed look at how call options work based off this payoff diagram that I created. So what you're looking at here is a graph showing profit and loss at expiration for two positions, a long call and a short call. Those are two different. There's two differences: a long and a call. Long and short, and both with the same strike price. So we're going to start with the long call, which is the blue line. When you buy a call, known as taking a long call position. So I'm just going to quickly say this. If somebody says I bought or long, it means the same thing. You buy or longing, it means you're buying and you're hoping the price goes up. This goes for stocks, ETFs, bonds, everything, and futures, whatever. Buy is the same thing as long, and short is the same thing as sell. So when I say long call, you're basically buying, and short call is just selling. So when you get a long call position, what you're doing is you're paying a premium for the right to buy the underlying asset at a specific price called the strike price, right? And so in this example, let's say the strike price is at $100 and the premium you paid is $5. So if the stock price stays below 100, the option expires worthless, right? Because since you paid $5, your maximum loss is $5, no matter how low the stock goes. That's why the blue line stays flat at -5 before $100, right? Because you don't have an obligation. You're not like if the price goes to 90, you're not obligated to actually buy, right? That's the thing with options. You're not obligated, but you have the right. So all you would lose is you let it expire and you're going to lose your $5. That's why right here your profit loss is here and then -5. However, if the stock price rises above $100, your option starts to become more valuable. And so every dollar above the strike price is profit. However, you also have to subtract your $5 premium you paid, right? Because nothing's free in this world. So you still have to pay some sort of premium. And so that is where this $5 comes. So at $105, you break even, right? So if the stock price, let's say, goes up to $105, you're up $5 technically on the option, but you still paid a $5 premium. So that's why right here we have a break-even point at $105. At $110, you make $5 profit. And so the higher the price climbs, the more profit you take. And the more profit you make. And there's also no ceiling to how high the asset can go. And so that's why the blue line keeps rising on the right. And this is where we say a long call has unlimited upside. On the other hand, a short call, which is the orange line, is when you sell a call. Short a call. We're gonna call short. When you short a call and you're giving someone else the right to buy the asset from you at the strike price. And so in return, you collect the $5 premium up front. That's your maximum profit. So if the stock stays at, so let's say stays at or below 100, the buyer won't exercise the option, right? And you keep the full $5. That's why the orange line is flat at $5 on the left. However, because right now, so when you're saying short call, you're basically the seller. You're like on the other side of the long call. So as we talked about long call, I'm now the seller. I'm the short call. However, if the buyer is correct and the stock price rises above $100, the buyer will now exercise their option and you will be forced to sell the stock at $100, even though it's now worth more. And so this is where your loss begins. So at $105, you break even, and at $110, you've lost $5. And as the price keeps going up, your losses keep growing with no limit. That's the risk of like being a short call without protection. The orange line drops lower and lower as the price rises. So as this person's making money, and the more money they make, well, obviously you're going to lose the money they're making because you're on the other side of the transaction. To summarize this, a long call offers limited risk and unlimited upside. A short call offers limited reward and a potential unlimited loss. The strike price is the key inflection point, and it determines when the option becomes valuable to the buyer or costly to the seller. So this diagram, I think, helps visualize how calls work and why it's important to understand both sides of the trade. And I just want to mention again, we'll talk more about managing risk in lesson 6, but for now, just remember, long call is buying the right to profit if the market goes up, and short call is like selling that right to someone else and taking the risk. Pretty much the same thing, but put. So we're going to talk about long put and short put. When you long a put position, that kind of gives you the right to sell the underlying asset at a strike price before expiration. So let's say the strike price is $100 and the premium you pay is $5. So if the market stays above 100, the option expires worthless and you don't need to use it. Because why would you sell something like at $100 if you can get more on the open market, right? And so in that case, your maximum loss is the $5 premium shown by the flat blue line I have right here. Yeah. Okay. Yeah. So, sorry, I lost my train of thought. So if the market drops below 100, your put becomes more valuable, right? Because we're betting that the market is going to go down. And it gives you the right to sell at $100 when the asset is worth less. And so the lower the price falls, the more valuable the contract becomes. And so let's say at $95, you break even, obviously. And at $90, you've made $5 profit, and so on. As the stock or whatever it is drops, you make money. However, there is an absolute best case, because on the call option, well, the price could keep rising. It could go up 100, 200, 300, 400, all the way up. Obviously, it wouldn't go up from 100 to $20,000 a share, but there is some sorts of unlimited growth space. However, unfortunately for puts, that is not the case, because the absolute case is if the asset drops to $0, you make $95 profit, right? Minus the premium. So unlike a call, which has unlimited upside, a put upside is capped, but it's still powerful for bearish setups. You could kind of imagine it like this. You have a floor and a ceiling. You could keep going up in space as far as possible, right? Obviously, there's a limitation of how high a rocket ship could go, but that's not the point. The point is you could keep going up. But down, you have the floor. You cannot just go down the floor. The floor is the maximum downside you can get. So that's kind of like a big thing about calls and puts is they don't really have opposite risks and reward. They're opposite, but they're not opposite when it comes to reward. Anyways, so let's look at the short put. So when you agree to short a put, you're agreeing to buy the asset at the strike price if the option holder chooses to exercise. And so in return, you collect the $5 premium up front. If the asset stays above 100, the option will expire as worthless. You keep the full $5. That's your profit. That's your maximum profit. And so that is shown right here by the orange flat line. But if the market falls below 100, the put buyer may exercise and you're forced to buy something worth less than what you're paying for. And so the lower the asset goes, the more you lose. And so at 95, you lost your $5 premium, right? You broke even basically. And at $90, you're down $5. And kind of as it goes, you lose more money. And so at worst, if it falls to zero, you'd still be forced to buy it at $100, which is actually technically a full $95 loss after you're subtracting the premium the buyer bought. And so that's the orange line dropping lower and lower as the price falls. And to kind of summarize this one is a long put, limited risk, high reward if the asset drops. A short put is limited profit, but risk grows as price falls. And so also the strike price is like the pivot point. Above it, puts lose value, and below it, they gain. Depends if it's long or short. And kind of just to summarize this, let's kind of bring this all together. And we're going to kind of talk about things from the last lesson as well, I'm pretty sure. Like a little bit, I might mention it. So there are only two types of options, a call and a put. And they behave in opposite ways, depending on where you think the market is headed. A call gives you the right to buy an asset at a set price, and it becomes more value as the market goes up. And that's why calls are used when you have a bullish outlook. A put gives you the right to sell an asset at a set price, and it becomes more valuable as the market goes down. So that's why puts are used when you have a bearish view. You can either buy an option called going long, or you could sell one called going short. When you buy an option, you're paying a premium and gaining rights, but you're not required to take action. Your risk is limited to the premium you paid. When you sell an option, you're collecting your premium, but you're taking on an obligation to fulfill the contract if the buyer chooses to exercise it. That obligation brings risk, which obviously, like I mentioned, we're going to talk in the next lesson. In the lesson 6. And so these four building blocks, long call, long put, and short put, form like this foundation of every option traders out there, no matter how simple or complex. And whether you're trying to buy a call to speculate on a price move, or you're trying to sell a put to generate income, everything starts with understanding these positions. And that's why I made this lesson too. It is very important to understand this. And yeah, that pretty much summarizes calls and puts. In the next lesson, we'll define the key terms you've already heard, like strike price, expirations, premium. Then we're also going to talk about a couple other definitions. We're going to talk about intrinsic versus extrinsic value, and then a couple more. So you could kind of understand what affects an option's value, and like, I guess more, like you'll see. That's going to be the next lesson. The next lesson is going to be more definitions. It's going to be a little boring, but those definitions are very important to continue on into the series. I hope you enjoyed this video. I tried to keep it not that long. It's very simple. It just calls and puts, and I'll see you guys in the next one. Thank you.